If the January jobs report misses this morning, silver could move fast, not because of hype, but because weak payroll data would immediately shift rate cut odds, hit the dollar, and squeeze real yields, and that's when silver tends to break out. The U.S. economy added 167,000 jobs in December 2025, while economists now expect roughly 185,000 jobs for January 2026, with the unemployment rate sitting at 4.2% and year-over-year wage growth near 3.9%. The Federal Reserve's policy rate remains in a range of 5.25% to 5.50%, while the 10-year Treasury yield has recently hovered near 4.05%. Headline CPI has been running close to 3.1% year-over-year, and core PCE remains above the Fed's 2% target. Silver, meanwhile, has traded near $31 per ounce after briefly testing highs above $33 earlier this month. Those numbers form the backdrop for today's employment report. If payroll growth materially misses expectations, for example, printing closer to 100,000 than 185,000, the implications would ripple through multiple layers of the financial system. The first reaction would likely occur in interest rate markets. Fed funds futures would immediately reprice, potentially increasing the probability of a rate cut at the next meeting from, say, 35% towards 60% within hours. That repricing matters because silver is less sensitive to the labor market itself and more sensitive to the path of real yields. Real yields are the anchor. When the 10-year nominal yield trades at 4.05% and inflation expectations sit near 2.30%, the implied real yield hovers around 1.75%. Silver historically performs best when that real yield compresses. During prior periods, when real yields fell by 50 basis points over a quarter, precious metals have tended to outperform broader equity benchmarks. A weak jobs print could push the 10-year yield down from 4.05% toward 3.85% in short order, tightening that real yield spread and reducing the opportunity cost of holding non-yielding assets. The second layer is the US dollar. The DXY index has fluctuated near 103 in recent weeks. If rate cut expectations rise abruptly, the dollar can decline 1% to 2% intraday, particularly when positioning is stretched. Silver is priced globally in dollars. A softer dollar effectively lowers the cost for international buyers. Even a 1.5% drop in the DXY has historically coincided with meaningful upside in silver futures, especially when speculative positioning is net short. Markets move not simply because of economic deterioration, but because expectations reset quickly. Third, the bond market's internal mechanics matter. Treasury market liquidity, as measured by bid-ask spreads and depth metrics, has remained thinner than pre-2020 averages by nearly 30%. When economic data surprise in that environment, moves are amplified. If yields fall 20 basis points in a single session, leveraged funds often scramble to adjust exposures. That repositioning can spill into commodities. Silver's daily trading volume is a fraction of the U.S. Treasury market's $600+ billion average daily turnover, meaning relatively small reallocations can drive outsized price changes. There is also the growth narrative. A labor miss signals deceleration. Consumer spending accounts for roughly 68% of U.S. GDP. If payroll growth slows meaningfully, markets begin to question forward consumption strength. Equity volatility often rises under those conditions. The VIX, for example, can jump from 16 to above 20 in response to macro stress. In prior cycles, when recession probabilities priced by markets exceeded 30%, defensive allocations to gold and silver increased. Silver tends to lag gold at first, but often accelerates once risk aversion becomes visible, rather than theoretical. Importantly, silver occupies a dual role. Roughly 55% of global silver demand is industrial, tied to electronics, solar panels, and manufacturing. The remaining demand reflects investment and monetary interest. If jobs miss modestly, signaling slowdown but not collapse, markets may focus less on industrial weakness and more on monetary easing. In 2020, and again in late 2023, silver rallied strongly when rate cut expectations increased, even as growth slowed. The key variable was not output, but liquidity expectations. Liquidity is the bloodstream of financial markets. The Federal Reserve's balance sheet remains above $7 trillion, even after quantitative tightening. Should weak labor data increase calls for policy easing, markets may anticipate slower balance sheet runoff, or even renewed asset purchases later in 2026. The psychological shift from tightening to easing is powerful. Silver often reacts not to the first rate cut, but to the realization that tightening is over. In previous cycles, silver has advanced double-digit percentages in the months surrounding policy pivots. Another dynamic is positioning. Futures market data frequently show speculative traders holding concentrated short positions during periods of macro uncertainty. If payroll data disappoint and yields drop 15 to 25 basis points, short covering can create mechanical buying pressure. Silver's market depth is thinner than gold's. A surge in algorithmic flows can push prices 3% to 5% within hours. These bursts are less about fundamentals and more about positioning imbalances colliding with new information. This does not mean any jobs miss guarantees a breakout. If payrolls decline sharply, for instance below zero, markets may interpret the signal as recessionary rather than merely dovish. In that scenario, industrial demand fears could initially cap silver's advance. But if the miss is moderate, enough to push rate cut probabilities above 50% without triggering panic, the setup becomes constructive. Lower real yields, a softer dollar, and shifting Fed expectations form a combination that has historically preceded upside momentum in precious metals. Ultimately, silver does not require economic strength to rise. It requires changing expectations. With the policy rate at 5.25% to 5.50%, inflation above the 2% target, and the 10-year yield near 4.05%, markets are balanced on assumptions of stability. A single data point, especially one as influential as monthly payrolls, can disturb that balance. If jobs growth undershoots meaningfully, silver may not respond because the labor market is weak. It may respond because monetary conditions are about to change.